Welcome back to You Heard It from ACFP. My name is Mathew Coyle. Today we're talking about what makes something expensive, and we're going to do a good old-fashioned kind of where do we stand in the marketplace as of today. A recent article got me thinking, so let's dive in. Yeah, love me some good drone flyover videos. Love those. That's a fun toy. But anyway, I digress. So, recent call by Goldman Sachs got me thinking. Goldman Sachs in the past, 10, 15 days or so, and I'll put the article somewhere up here from somewhere. Goldman Sachs forecasting a dead decade for the S&P 500. Should you sell your stocks? Now, this got me thinking that we don't really do I don't do like security valuation videos and stuff like that, but it got me thinking, what is expensive, what is cheap, how do we measure these things, and how do you know where to put money over the coming decade? Now, if they are, if we see what the returns they're predicting, which are growing at just around 3% a year, that's pretty rare. You don't see stocks over a decade plus-ish grow at over only 3% a year. Usually corporations are pretty good about making money, raising their earnings, and improving their margins, which ultimately corporate America is pretty good at that. And that's ultimately what drives stocks. It's not necessarily elections. It's actually earnings. And they're pretty good at raising and beating earnings expectations over long periods of time in this country. Or at least we have been for a long time. So to see a forecast like that is an interesting one. And it does kind of raise the question, where do you put money? What do you look at? What are the options? Because we have had a pretty good decade in the past, let's say 8 to 10 years. In the US markets, it's been a very good time to be an investor over the last decade. Whether you're above 10, below 10, whatever your risk tolerance is, we're all different. But bottom line is it's been a very, very good year, a very good decade, I should say, and a good year for U.S. stocks. And it has been really not very good at all for foreign markets, although it seems to be changing a little bit. China's rallying again, blah, blah, blah. Anyway, so this got me thinking, have we ever done a video on security valuation? Ever done how to look at whether it's cheap or whether it's expensive? I'm going to compare two very similar companies in a way that we look at markets or the way we look at stocks. I'm not endorsing any stock to buy. You buy what you want with our help or without it. But how do professionals look at stocks versus being cheap and expensive, all that? So we're going to compare two companies in almost identical, they make almost identical products or very similar products in the same exact industry, valued very, very differently. And then you can compare the two. So let's dive into that. All right, like I said, I don't do a lot of securities valuation videos, and for your sake, you're probably glad I don't do that. But anyway, I'll try and keep this as interesting as I can. We're going to look at two companies, and I'm not endorsing either one. Before we even get into this, this is not a solicitation of a product or a service, okay? You buy whatever stocks you want to buy, and I'll explain why you would buy each one, okay, based on your situation. However, we're going to compare two companies. We're going to compare Toyota, and we're going to compare Tesla. Two companies, same industry, almost identical products. I mean, not identical, but pretty close, right? Built in the same way. Tesla never likes to call themselves a car company, but when you bend metal around four wheels and then drop a steering wheel in it, it's usually a car. Sorry, Elon, but that's what you do. So let's look at Toyota and let's look at Tesla, and we're going to look at two companies that are valued very differently and why you'd buy each one. Again, one's cheap, one's expensive, but you can make a case for either one based on your own personal plan. And again, I'm not endorsing either one. I don't want anybody email saying I endorsed or told you to buy a stock. Do not buy based off this advice. This is purely for educational purposes only. But that's right, no buying. All right, Toyota. We're going to start with Toyota. As we all know, Toyota is a car company, biggest car company in the world. They are nothing new, pays you about a 2% dividend yield to own it. But if you look at the numbers of a Toyota versus Tesla, let's start with Toyota. It trades at roughly $176 a share as of the making of this video. That is not by itself very interesting. But what is interesting are the metrics you use to value them. So when a professional stock picker, when an analyst looks at companies or looks at indexes or look at anything with a price target on it, and sometimes this is why I get uncomfortable saying, well, the market is overvalued. Well, which market? Which one? So Toyota currently trades at a price to earnings multiple of 8 forward times. What does that mean? It means that they're taking the earnings per share and you're paying 8 times the earnings per share price to get that share. So $176 roughly is 8 times the value of one earnings share or one earnings amount per share for Tesla. So they take the total earnings of the company, divide by the public float, which is the share count, and they get an earnings per share. You then multiply by 8, and roughly you're at $176 per share. That's the rough math. Okay, you're paying 8 times the earnings to buy that per share. Now, interestingly enough, You can measure this a couple different ways. You can also do what's called a PEG ratio, a PEG ratio, and this is how a lot of people look at stocks. They don't just look at the PE, they look at the PEG or PEG, which is price earnings to growth. So if you look at the PEG ratio, you'll find that Toyota is trading at about 1.5 times its growth ratio to buy that company. So if you're buying shares of Toyota, you are paying 1.5 times its growth rate per share to buy the shares in that company. And again, we'll look at Tesla in a second. Now, historically, this is a little bit low for Toyota, right? In the past, in 2024, I'll just read these off. It was 3.6 times. In 2023, roughly, it was about 2.5 times. It's been somewhere between, 6 times on the high end, and where it currently is now about 1.5 times on the low end. So historically, you could say that Toyota is fairly cheap. Now, would you buy it? Well, it depends. It depends on what you're looking for, right? Are you looking for a growth company? Maybe they're not growing as fast. You might not buy it. You might buy something like Tesla, which we'll get into in a second. Now, the last thing I'll talk about is price to sales. When we look at whether something's expensive or not expensive, we look at something like price to sales. What are you paying relative to the sales of the company? Because price to earnings is relative to profits, right? The earnings. If you look at price to sales, or what the revenue generates to the company, it's only 0.8 or 0.78 times price to sales. So on a relative basis, you could say that Toyota is fairly cheap. Now, if you're buying it, you're probably doing it knowing you're not going to get as much growth, right? This is a company that is it's the biggest automaker in the world. Large companies grow slower; they don't grow as fast if they grow at all. And you're getting a dividend yield of about 2%, so you're getting some money for owning it. So if you are maybe a little bit later in your life, or you are still wanting to own stocks, but you don't want to own the riskiest automakers in the world, you buy Toyota, and that might be something for you, not an endorsement. Anyway, so on a relative basis, Toyota, by these measures, is actually pretty affordable, pretty cheap relative to its earnings and to its revenues. Okay, now let's do Tesla. If you look at Tesla, it trades for about $259, $260 a share as of the making of this video. Again, not an endorsement. Do your own homework. But if you look at it relative to its price to earnings ratio, as we did with Toyota, it is currently trading at a forward price to earnings ratio of 78 times its earnings. So if you want to buy Tesla, you better be in it for the long run, because that is a very expensive stock relative to its earnings. It's trading at roughly 7.5 times its growth rate, 7.49, whatever, 7.5 times its growth rate, and about 12 times its price to book value, and more importantly, 9 times its price to sales, 9.5 times almost its price to sales. So when you look at these are two companies in an identical industry. I mean, one sells mostly hybrids and traditional automobiles, one sells only EVs, but they both make cars. Yes, sorry, Elon, that's what you do. You make cars. They're a growing energy business, but right now most of their money comes from cars and carbon trading, by the way. They do a lot of carbon credit trading. It's very profitable for them. Not an endorsement. So two car companies, very similar products, almost identical industry. Well, basically the identical industry. One trades at a very cheap 0.7 price to sales. Another one trades at 9.5 times sales. Footnote, Toyota has never traded above 7 times sales in the past 5 or 6 years. It's never been that expensive. All right, so why did I go through all of that? So just like you apply those ratios to Tesla and to Toyota, you can apply these ratios to the entire market, but with a bit of a twist, right? To decide whether the market is cheap or expensive here. So let's look at the S&P 500, because that is the most commonly used large cap index in pretty much the world, I would say, if not, well, yeah, probably. The Wilshire 5000 comes close to, but let's use the S&P 500. It is a large cap growth index, excuse me. And we'll look at something called the PE10. So the price to earnings ratio, just like a stock, can be quite volatile. It can bounce around quite a bit. So in order to smooth things out and get a better historical look at it, sometimes you'll use a rolling 10-year average or rolling 10 years to smooth things out. And that's what I've done here with this chart, or what the folks who created this chart, what I'm using here at Advisor Perspectives. That's what they've done here. So basically, you can take the earnings of an index just like you can take the earnings of a company, right? You take the earnings per share of all the member companies in the index, add them all up, compare them to the price of the index. You can get a per share of the index earnings ratio, and there you go. You've got your price to earnings of the index. So just like you apply that to a stock, you can apply that to an index as well. And as you can see from this, we are a little bit expensive in the market now. Large cap stocks have had a heck of a good run the last 10 or 12 years. The market is a little bit expensive here. In fact, we're about 170% above historical regression, which is expensive. There's no doubt about that. So if you're placing new money in the market and you say the market is expensive, large cap stocks might be expensive here. There's no doubt about it. And I have my own feelings on this. Again, not a recommendation as to what to buy, but just something to consider when you are putting new money into the market. All right, so can we apply this to other markets? Well, yes, we can. If you look at various sectors of the market, large cap, small cap, mid cap, even mega cap, which is kind of your, let's call it the Magnificent Eight, so to speak, your big technology companies that dominate the S&P 500 and other indexes, you find that these large cap stocks in the market right now, as well as the S&P 500 in general, okay, are fairly pricey historically. Q next chart. This is courtesy of Standard & Poor's data and Yardeni Research. These particular indexes show that both the small cap and the mid cap are relatively not cheap, but less expensive than you'd say the S&P 500 would be, or in certainly the mega cap stocks would be that people have been buying for the last decade or so. That purple line, of course, being the mega cap line of the big eight. That'd be like your Metas, your Microsofts, your Apples, those companies right there. So what does this all mean? Well, it means that depending on when you say the market is expensive or the market needs to be avoided for the next so many years, I don't know what the return of the next decade will be for stocks. And to be fair, neither does Goldman Sachs. But they have their guesses, I have mine. But when you say the market is expensive, which market are we talking about? Where could new money go? These types of questions are always interesting to postulate about, where to put money. But basically, the small and the mid cap names continue to be more affordable historically. The large cap names may be a bit expensive at this point in the game, but that is kind of where we stand right now. So there you go. That's Securities Valuation 101. Now, whether you are a growth investor or a value investor, maybe you're a young person, older person, what have you, you make those decisions, what you buy based on how much you are paying relative to what that investment is likely to generate. That's kind of the overriding message of this little spiel here. So when you look at the market being cheap or the market being expensive, remember the market's a pretty big old place. And if you look hard enough, you can find pockets or places where you can put your money. And if you can't decide, hey, 4 or 5% on cash is not a bad thing either. So with that, I will leave it there. Thank you for spending your time with me. It is your most valuable asset, so spend it wisely. I will talk to you later. That's episode 79 of You Heard from a CFP. Take care. I'll see you next time. Bye.